This current decline in commercial real estate prices during a U.S. monetary policy cycle of tightening is actually rare. This isn't normal. It's like striking how much different it is than previous cycles. In the 2004 to 2006 cycle, we actually saw the biggest increase in commercial prices during a tightening cycle. In 2005 to 2019, while they were slightly tightening, still cycled up. In the mid 70s, up a little bit. Late 90s, up a little bit. Late 60s, flat. Mid 90s, flat. Okay, 1977 and 1981, up a little bit, down a little bit, just hovered around. But remember, that was during that massive inflation. 88 to 89, down. 83 to 84, down. 22 to 23, down by a magnitude of order double, 2x, what we had seen in any previous monetary policy tightening cycle. That's what's interesting. So the Fed is looking at this. This is why I said, if you need to go review that, go to episode 46, go to episode 44 and review what we've kind of already talked about in those podcasts. The Fed is seeing this and they said, wait a second, this is the most it's ever dropped. Why? Because when we joke about how the Fed broke housing, the Fed also broke commercial real estate with cheap 0% Fed funds rate, kept commercial debt at anywhere between 2.5% to 4% for too long, which caused a lot of speculation, which caused easy money, which caused the TikTok syndicators to come out of the woodwork, people who should have never been putting together syndications because money's raining from the heavens. And so the Federal Reserve is taking some of this back right now and deflating part of this bubble. This is a good thing if they can do it controlled. Because you know how they have this thing in dealing with forest fires and land management. It's called a controlled burn. But do some controlled burns get out of control and then literally light the field or the forest on fire? Mm-hmm. The Fed is hoping to stick the soft landing, but this is the proverbial controlled burn, and this is the strongest we've ever had it.
Another thing, when you look at this chart, is it's getting faster and faster.
Yes.
These extreme moves. And if you just think about commercial, why commercial in history wasn't as big of a problem is because it was a little bit more conservative, because it just moved slower.
In the late 70s and early 80s, thank you, BlackRock. BlackRock started coming out with their ETFs, and we started coming out with mutual funds. And Wall Street started inventing these exotic products. And these exotic products led to mortgage-backed securities, which has led to the commoditization of commercial real estate assets. And then over the last crazy decade, basically from the Great Recession, 2012 to literally 2022, commercial went on a tear because of those exotic products, because more people could invest easier through different means into commercial real estate. This rapid change in monetary policy is what's causing this stress on the system. What it's also done is it's taken private equity, which is generally a major source of funding. So private equity would also be one of your cash buyers, and started pulling private equity back out because private equity is not investing as much. And then in turn, that's caused rising cap rates and the need for increased debt service coverage ratio. So what's that caused our banks to do? This has caused our banks to tighten lending standards because they see these numbers coming down. And so the banks are going, you know what? If Benji wants to come and buy an asset, we're going to need a lower loan to value. We're going to need more reserves. We're going to need a higher debt service coverage ratio. Oh, and by the way, because even though you've paid every loan on time with us for the last 100 years, we're going to increase the spread. So we talked about this before. I was talking to a local community bank, and over the last year and a half, here is what has happened. Generally speaking, their commercial debt was the 5-year Des Moines FHLB plus 1.5. 1 if you were their golden borrower, 1.5 if you were the okay borrower. All of a sudden, the Fed starts raising rate, that's 2. 6 months later, it's plus 2.5. Talked to them a month ago, it's plus 3. For some borrowers who don't have deposits with them in a relationship, if you're an outside borrower coming to that bank today, it's plus 3.5, unless you bring significant deposits. I said, what's significant deposits? Oh, we'd need to see 400 grand, at least. So wait a second. In order for you to give me a loan and give me a slightly better interest rate, you need my cash to buoy up your balance sheet because of this potential risk that's blooming in the background. Now, once again, we're talking about potential risk. This is the potential tsunami. This is not a guaranteed, because you don't know which way the chips are going to fall. But this is also a event that creates opportunity.